All right, good afternoon, everyone. This is Jason Putnam Gordon. It's a couple minutes after 12 here in San Francisco, California. We're going to get the webinar started today. Today we'll be talking about seed funding. This is Seed Funding 101, basically the what, where, when, and how. Before we do that, I'd first like to thank you for attending, and I have to say that I'm pretty excited to host this webinar. We've given this webinar, well, we've given this presentation in a few different forms before. This is our first time doing it in the webinar form, and so bear with us. If there are any snafus, we'll get them fixed. I've been playing along here. It looks like folks are able to hear me, so that's fantastic. If you're having trouble hearing, go to the audio section and adjust the speaker settings. Additionally, and this doesn't seem to be a problem, but please make sure that you're on mute. As I'm taking a look at the dashboard here, it looks like everybody has muted their microphone if they've signed in for a computer. I think we got one individual, Philip Kim. If you're on the phone, it looks like you're muted too. So that's going to keep us from hearing the echo, which could be a problem. So a couple other notes. The slides that we're going to be going through today, you should be able to see them, and then they are one of the handouts. So if you look down on your dashboard, you'll see seed financing slides. You can take those. We'll also circulate them to you after the webinar. So you should be able to get a handle on them, and we'll probably also put them up on our blog. So if we don't send them directly to you, we may send you an email and just put a link to our blog. That might be how we handle it. So as with all of these things, let's get rolling, because I'm sure you guys have other things to do. So before we get started, it's important for us to kind of go over what I like to call the important caveats. So today's discussion is general information. It's not legal advice. During the course of this discussion, we'll be going through the rules and the exceptions to the rules. We'll talk about some fact patterns, how they may apply, how they may not apply. But it's not going to be specific advice to your situation. And that goes for even if we answer questions that you have, and I want you to feel free to send in questions as we're moving through. Even if we go over your question, it's not going to be specific legal advice for you because, I'm not going to have all the facts to be able to give you a good answer for that. So with that in mind, let's kind of talk a little bit. I'll give you the overview of what we're going to do today. First, we're going to start with background. We'll go over my background, your backgrounds, why it is that I'm here today talking to you about this stuff. We'll talk just briefly on entity formation and sort of big picture items. We'll talk about financing options, and within that we'll talk about convertible debt, convertible equity, and Series Seed. The focus of today's discussion is seed financing, so you're going to get to learn all about that. You'll get the overview and some of the nuts and bolts, and we'll work in some pitfalls as well. So what my background is that I've been practicing law for over a decade now. I'm a corporate and securities attorney. We're based here in San Francisco. We've got clients here in the Bay Area, and we also work with companies throughout the U.S. and all over the world. I started this firm 5 years ago after working for a very large technology-focused law firm. One of the things that I think makes us a good fit for technology companies, startup companies, and middle market companies is the fact that I'm an entrepreneur. I'm starting my own practice, so I bring the same level of energy and enthusiasm to what it is that I do for my practice as I do when working with the clients. So I think it's kind of a shared love. Outside of practicing law, I like to always give a little bit of a tidbit, which is that I'm a competitive skydiver. I've got over 1,200 jumps. I just got back from Nationals. That was at the end of October. We got second place in our event, so pretty happy and excited about that. And I want to learn a little bit about you guys, so I'm going to be paying attention to the questions section. And just to confirm with Philip, I got you, or you are muted, so you're good to go. So I want to pay attention to the question section. I want to learn a little bit about you guys. So if you could just kind of reply yes if you're in a startup. Let me know if you're a founder, if this is your first startup. Kind of knowing some of these things is if you just sort of type in there I can follow along. And for those of you who like skydiving, we can talk about that too at some other point in time. And we'll talk about that a little bit later. All right, so we got some first-time founders here, which is fantastic. Great. So let's talk about who's going to get sort of the most out of this presentation. So I think the most value is going to be for somebody who is about to raise or is in the process of raising seed financing. Uh, Other folks, if you're in a startup or you're thinking about doing a startup or you're in some other company, I think you'll still get some value. I think, we're going to be talking some big picture items at first, and so hopefully you'll get some additional information, kind of see where your company is or where you might be in the life cycle and where this sort of fits in the life cycle for startup companies. So with that in mind, let's talk about seed financing. So seed financing or seed funding is about basically getting the nucleus of your idea up and going. Okay, so maybe previously you've got some sort of idea. It's on a whiteboard. Um, but maybe you start tinkering with something, maybe you've got a partner, but you need to be able to kind of put together a prototype, some sort of working demonstration of what it is that you do. So whether that is, a piece of hardware, whether or not, some sort of revolutionary new camera invention, maybe like a stabilizer for an extreme sports camera, or maybe it's something software related, right? I mean, it's the beginnings of the outlines of some sort of social network, or maybe it's proof of concept video game. Uh, seed financing is about getting the money together that you'll need to put together a prototype and the initial team. Now, most of you folks probably got an email from my assistant Alan, asking whether or not you had any questions before we got going, and some folks are interested in, well, who do you get financing from, or who would be a potentially good fit for you? And, what we like to say is you should be targeting people with whom you've had a relationship in the past or with whom your relationships have relationships with, and they should be in the sector in which you are participating. So what does that mean? That means, if you're putting together a company that does a social network, okay, you will want to be working with people who have been in the social network space before. Um, why is that? Well, in large measure because, well, there are two reasons. One, they'll have a better sense to know whether or not you would be a good investment. And then another thing is that they may have connections, okay? Because connections are very important, especially in the startup ecosystem. And having not only the cash, but the ability to connect to the people who will either put you in touch with other folks, or whether they're other investors, or whether or not they're other people who have access to resources, whether they are teams of folks who can do the coding, or whether or not they are folks with hardware expertise if you lack that. That's pretty critical. One of the things to be careful about, though, is that if you're going to be going out and trying to obtain investment from friends and family or other folks who are in that space, um, you may be a competitor for them. They may be pumping you for information. So you got to be a little bit careful. It's kind of always one of those things in life where you got to walk that line. But uh, bottom line is, if you're an ag tech, let's say, you're going to be wanting to work either with, angel investors that have experience in ag tech, and or, uh, sometimes some of the venture capital firms they do some angel financing as well. So let's just dive down a little bit more and talk about where specifically in the life cycle, or when specifically in the life cycle there's seed financing, as well as how much money we're talking about here. So here's a great little graphic that I just found the other day. It was even just on Wikipedia, which we're allowed to use. So If you think about sort of the startup financing cycle, and I don't know if you're able to see, you're sort of able to see me move my cursor um, over this graphic here, but seed capital is very early on. Okay. Now this also has a revenue graphic, which is maybe not true. I have to say that most of the time we don't necessarily see startups get cash flow positive or revenue positive um, in the seed stage. I mean, normally it's not until they've at least hit their Series A or B, and maybe even later. I mean, you can look at Amazon, and the last time I looked, Amazon was still losing money, but it certainly is a pretty hot company. So the point is, seed stage financing is very early on. It's talking about building out those initial teams. So, it can be anything from a few $100,000 to a couple $1 million. Usually after you kind of cross the $2 million mark or so, you're moving more into Series A financing. Now, Series A financing is coming later and later. I think the median financing these days is like $7 million or something. So, seed funding can go on later than that. Uh, but that's sort of generally what you're thinking. So we're talking about raising, a few $100,000 to a couple $1 million. And we're going to talk today, we're going to transition and start talking about how you do that. That is like sort of what the mechanics are, what the documents are, what the general issues are that are associated with that. So I kind of presume anybody who's on, listening to this webinar has probably done some research on their own. You're probably pretty intelligent and probably also pretty curious. So you've probably gone out and maybe read some blogs and probably started doing some of your own homework. So you'll see that the general options, at least in the sort of technology or startup world that we spend a lot of time in, are convertible debt, convertible equity, or Series Seed. And we're going to talk about those things today. Now, convertible debt, convertible equity. These guys they're like kissing cousins, if you will. They go by a couple different names. Okay, convertible debt, sometimes called bridge notes. That's the more old school word for them. They come up. I think there are some companies out there, like 500 startups, that have their own form for them that they try and market and use, and those are called KISS notes for uh, was it keep it simple security or something along those lines. Um, same thing, convertible equity. Convertible equity is the older school name for it. It's still a pretty new instrument. It's only been around since I think 2012, 2013. Um, and you may have heard of them. Y Combinator has its own. It's called Safe Instrument. One of the other things that are out there are Series Seed. So, Series Seed is it's a form of stock. Okay, it's a form of preferred stock. The older school name for it was Series AA, and it's basically a stripped down preferred stock, and we'll talk about that a little bit later. And then as you start to move out of the seed financing, we get into more traditional venture rounds. And I'm going to put a plug in. We're going to do another webinar that's going to be next month on the 16th, or excuse me, on the 12th of January. And so if you want to learn about that, would love to talk about that. And we could certainly spend hours. So let's kind of talk a little bit about where these guys fit into the picture. So we generally sort of find that convertible debt or convertible equity is done earlier or sooner or with smaller amounts. So what do I mean by that? I mean, if you're raising a few $100,000 or $1 million or even $1.5 million, um, we find you and end up in the convertible debt or equity section. If you're raising $1 million, $1.5 million, 2 or 3, we're gonna see you sort of sliding more likely into the Series C area, and then as I said before, Series A rounds keep getting pushed back farther and farther, but 2, 3 million and up, you're kind of moving into A territory. So let's talk about. I'm going to talk to you about convertible debt, convertible equity. I'm going to lump them together in a term just called convertible securities, and we'll pick apart some of the differences between the two and what you'd expect to see in them. I'm just going to pause here, and looks like we got a question. So, ah, great question. At what stage do I need to appraise the valuation of the company? That's from KB. KB, we're going to get into that right now, or at least in the next slide or two. So, what does convertible mean? Well, it's kind of what you'd think, right? It's something that changes into something else, just like a convertible car. First it has a top, then you put the top down, you got a car without a top. Um, Basically, it is a right or a bundle of rights to convert some security instrument into another security instrument, usually with a discount at some sort of future financing. Now, kind of address what KV was asking, when do you need to appraise the valuation of the company? Well, the answer to that is you generally don't do that you don't do that in a convertible security, whether that's debt or equity. And that is actually one of the selling points of this kind of security, um, because you don't need to value it. So you may ask, well, why is that, or how is that, or why is that some sort of benefit? Okay, so let's first take the question of why is that a benefit? Well, the answer is it's very hard to value an early stage company. Um, you really, one of the reasons, especially in this particular kind of market, startups are there to uh, change the marketplace. They're either developing a technology and creating a market where there was none, or you are completely reorienting how the market currently is. So let's take some harder examples, or some more concrete examples than that. Kind of before Uber, there were no ride-sharing apps. Uber created that platform. Okay, other folks came in, Lyft, Sidecar, yada yada yada. Now, granted, there were taxis around before, but arguably nobody had successfully prepared or paired cars, that kind of transportation, and an app. Versus Google. Well, Yahoo was around before Google. Yahoo is still around, sort of barely. But Google completely revolutionized search. So, the kind of question is, how is it that you know what the value of the company is? How do you know what kind of revenue is going to be made? Um, and You can't. So, the danger is if you value the company too early, or excuse me, with too little, and then potentially you're giving up way more of the company than you should, and vice versa. If if the company is valued too highly, then the investors aren't really getting the return that they're seeking. So doing convertible debt or equity avoids this risk. KB's asked a follow-up question, which is how do you then calculate the valuation caps of convertible notes? We're going to get to that in a minute. So what is another advantage of a convertible security? Well, it's less expensive to do than a Series seed or a venture round. The reason for that is that there's just less to negotiate, basically. The documents are much more standardized, and there's just less things to argue about. So moving on, I'm going to highlight some of the differences between convertible debt and convertible equity. It really just centers around basically whether or not there is a debt component, i.e. a part that you have to pay back. There's no maturity date. So think about a student loan, right? You borrow money from your bank, okay, $10,000, you got to pay that back with interest. Um, Convertible debt would, you borrow, let's say $100,000 from an angel, you got to pay that money back with interest. The date that it has to be paid back by is the maturity date. If you don't do that, then one of two things happen. There's potentially a default, or maybe you have conversion terms built into that, so it converts into common stock or something else. Convertible equity does not have those attributes, okay? Convertible equity is just basically a right to buy in at basically normally the preferred round. There can be some conversion terms if you don't close a qualified financing in time, but that's it. Um, there's no debt. There's no concern that basically if you don't pay in time, you could get um, hauled into court and sued for not paying the money back on time. One of the other important terms within these securities is the um, amendment terms. Okay, this is something that's sometimes left out of either the Y Combinator safe instruments or the KISS instruments, so you got to be careful there. You want to make sure, let me take a step back. One of the cool things about working in this space is that we get to help entrepreneurs solve problems. Okay, frequently their problem is they don't necessarily have enough capital to be able to grow the company. We get to help them do that when they find their investors. The deal that you cut today is the deal that you need to live by, but things happen. Okay, maybe your company becomes super hot, maybe you have an issue, maybe your company is no longer as hot, and you need to be able to change the deal that you cut. Well, you need to have a mechanism in place so that you can potentially get that done. Um, the amendment terms govern that. So you don't necessarily want to have to run around to each note holder and have to have them sign off on the amendment. You want to have a mechanism so that the person or people who hold the majority in interest. So let's say you raise like $1,000,000, you want to be able to go to the people so that so long as you've gotten $501,000 worth of note holders signing off, you can change the terms. Now, it's not that common to negotiate other terms. And we'll walk through some of those. I see questions trickling in about interest rates and caps and stuff. So let me just say, hang tight, we're getting there. And it's good to have such a proactive audience. I appreciate that. So within the maturity date section, you normally see 18 to 24 months of maturity date. What you want to do or what you want to be thinking about is timing it to when you're going to have a venture round, right? Or at least until you're going to be able to raise your next round of financing. Now, why is that? Well, especially if you're working with convertible debt as opposed to convertible equity, um, you don't want to you don't want your investors to call the note or have the ability to call the note before you raise more money, before that note converts into basically the preferred stock. Um, Otherwise, you can end up getting screwed. Now, some of the things that you need to pay attention to, especially if folks are doing their own legal work, which is always very dangerous, is making sure that you pay attention to the California finance lender law or similar laws in the jurisdiction that you're in. What you don't want to end up doing is, having your friends and family members uh, basically violating that law, potentially opening themselves up to statutory damages. And then the other thing too, you got to be careful of usury laws too. But that kind of gets to our next slide, which is the interest rates. So interest rates. It can be low as the applied federal rate. And if you don't at least put the applied federal rate in there, you can get imputed interest. So what the hell does that mean? That means basically, the IRS recognizes that there's a time value for money. If I give you $1 today and don't charge you any interest, that's better than if, you could take that money and invest it elsewhere. Um, so so that's what that is, and it's basically you'll end up getting taxed on it, or the company will end up getting taxed on it, which is kind of a pain. It can be as high as 10% in California. And otherwise, you start to run into usury law issues. We sort of normally see this around 5 or 6%. Kind of in sticking with the general theme that we have, when you're setting yourself up, whether it's convertible debt or convertible equity, you want to be, or the way that you're setting up your company, you want to make sure that you're kind of plain vanilla. And unless you are super duper hot, right? And by super duper hot, I mean you have some sort of market cachet that nobody else has. Basically, if Mark Zuckerberg were to leave Facebook and start a new company, he could set it up. Well, one, he could finance it, so kind of is not an issue. But two, if he went out to investors, he could dictate the terms, right? Because he's had a tremendous success. If you've not had that demonstrated success before, you're probably not going to be able to command those terms. So what do I mean by that? I mean, if you start giving, well, we're going to get into some of these other terms, but basically as it comes to either the interest rate, if you start giving, 20 or 30% interest rate on this, one, you're going to have some potentially issues with the laws, and then two, that's just not market. So your later investors, when they come along, they'll say, well, these seed investors are getting too sweet a deal. You need to recut that deal. Now, that can always happen. That's going back to the majority and interest in the amendment section we were talking about before. That's one reason why you want to have that in there, because maybe to get that next round of funding, you need to recut the deal you did today. You need to have that mechanism in there. But again, you want to be kind of plain vanilla. Now, let me just take one moment and run back through these questions here. I think I addressed the typical interest rate, and someone had some issue with the sound. So can we help companies or founders in other countries? Yes. We'll talk about that at the end of the show. Sound came back. We'll talk about conversion in a second. Someone's confused and thought interest expense was a tax deduction. Yes. Interest expense is usually a tax deduction, but what I'm saying is if you're not charging interest, then the IRS will impute that there was interest, and so you will end up getting a nominal charge, basically. Right? Because when you deduct something, you get a bunch of credit for it, but you don't get full credit for it. So that's basically the issue there. So let's talk about conversion terms. Now, this applies for convertible debt or convertible equity. Okay, the point here is you don't want to have these notes outstanding forever. You don't want to have these convertible equity agreements outstanding forever. They need to convert into something. So the point of them usually is to convert into basically what the Series A holders are going to get. So what you're going to want to do is you're going to want to put some conversion terms in there. Those conversion terms usually specify that, basically you want to have some sort of threshold that, you don't want to basically have to convert something, if you're just going to be if you're going to be selling stock to another founder for $10,000. That doesn't make any sense. You want to make sure that there's a big enough round so that basically there's a full vetting and valuation of the company associated with it. So you're normally going to set in there at least a minimum size. You're not going to want to have other debt rounds inadvertently trigger these these provisions, so you're going to want to also specify that it's an equity financing. Most of these instruments have what's called a discount. We sort of see that it's normally between 20 and 25%. It can be structured in a couple different ways. Sometimes it's like, it's a percent a month. So basically if there were to be a conversion the first month after the convertible debt round, it'd only be 1%. If it goes to 36 months, then there's a 36-month discount. If you're cutting too sweet a discount, then basically what that means is that the note holders are going to get to buy in at 25% off whatever the Securities A holders are going to buy in at. So if it's too sweet a deal, the Series A holders are going to say, look, we're not interested in investing if these guys get to basically free ride so well. So the point is, you want to look kind of plain vanilla, otherwise you're going to have to recut that. The same thing too, right? So discounts are one way to reward those really early stage seed investors, right? So basically they get to apply their money and get 25% off whatever the venture capitalist is investing in Series A. The other way to do that, and which is very popular, caps. So it probably gets people pretty excited. Usually this provides basically like a sweetener, right? So the way that these things work out is that let's say your Series A round comes along, okay, and they're going to say, your company has a pre-money valuation of $4 million, and so we're going to put in $1 million. So at the end, on a fully diluted basis, we're going to own 20% of the company. Uh, and in the meantime, let's say your company had let's say your company had $500,000 in convertible notes or something out there, and there's a 25% discount. So, basically, if there's a discount in there, in the pre-money, then the convertible debt holders or convertible note holders are going to have, you know, they're going to have a bit more in the post money in terms of, you know, what did I say? I think I said $4 million or whatever. So rather than 1/8, they're going to have a little bit more than like 1/8 of the company. Sometimes that's not enough though, right? And the Series C folks are concerned that, well, what happens if in the Series A rounds, the pre-money valuation is not going to be $4 million, but it's going to be $40 million. Well, then I'm only going to have put in, $500,000 into um, a company that is a $40 million company. I took all the risk initially, and so as a consequence of that, um, I'm going to have, instead of having, 1/8 or a little more than 1/8 of the company, I'm going to have, 1/80th of the company, or, a little bit more than 1/80th of the company. So what the cap does is it basically acts as like a boost, so that even though the pre-money valuation or whatever would be $80 million, it would still act as if the company were only $4 million. So again, what that does is that takes money, or basically uh, ownership, out of the hands of the founders, puts it in the Series A excuse me, in the seed holders. So in those situations, those are pretty extreme numbers, but that's exactly how it would happen mechanically. In that situation, we usually see that these things sort of get renegotiated. Okay, so that the Series A folks aren't going to want to see these angels with such a large amount of the company. I mean, it's true they took the most risk sort of earliest on, but having them only put in $500,000 into an $80 million company, and having them walk away with an eighth of the company, that ain't right either. So a lot of that stuff gets knocked down. Now, somebody asked earlier about how is it that you actually um, set the caps, and I think that is a really, really, really good question. And then sort of the corresponding question that comes up from time to time is, well, isn't really a cap evaluation? And the answer is no. The cap is not a valuation. I mean, it kind of acts to a certain extent as a at the point of conversion as a valuation, but it doesn't, in the sense that one of the issues about valuing a company early on, obviously, one, it's very risky, and two, if you're going to be granting either stock, restricted stock or stock options to employees, that needs to get done at fair market value. So if you start valuing the company, then you're going to be establishing the value of what you have to issue stock to employees. And if the fair market value of the share is $1 a share, and you're giving employees stock at a tenth of a penny a share, those employees are going to have to pay tax on that stock. So one of the issues that comes up is if you start pricing too early on, you're not going to be able to use cheap equity to reward employees for coming on early and getting involved. Moving back to the question of valuation and how you set a cap, it's kind of whatever the market will bear. So there are, Series C financing documents and surveys out there indicating what the market is bearing. I think typically we see around, between a $4 and a $7 million cap. We've done deals, and you can do deals where there's no cap. I mean, that is in the best interest of the company and the founders. But usually, if you want the money and you're working with a sophisticated investor, they are aware of the fact that they might misguess, right? They may put in $500,000 and by the time you actually grow and scale, the company is worth $80 million, and so they've really missed a big piece of the pie. So they're going to probably insist on a cap. But again, we see sort of, caps from $5 to $10 million, and sort of typically see them come in around seven. There are surveys out there you can see them and look them up online. Kind of keep your fingers on the pulse of it, and then again, if you can get away without putting a cap in there, that is fantastic. Let's take a look here. So moving right along, because we haven't even gotten to the Series C stuff, but we're working on a good time here. Um, Structure, okay. Generally, there's two documents in either convertible debt or convertible equity. There's either the note. There's normally a purchase agreement, and then there's normally the security. At least in convertible equity, it's no purchase. Excuse me. In the convertible debt, it's a no purchase agreement and a note. Um, in convertible equity, it's an equity purchase agreement, and then the the security, basically the safe instrument. Now, sometimes, and what's becoming really popular, and is somewhat efficient, if you will, some of these documents, whether they're safe instruments or KISSes, they basically combine the note purchase agreement and the note, or the equity, the safe instrument, all in one. That has its advantages. One, it's one doc, it's much easier to kind of produce. The downside, again, is that if you're doing rounds, you may have to, and you're not paying attention, you may have to go back and get approval from each one of those note holders before you can change the agreement or relationship, and that can be, that can save you a bunch of money in the short end, and then in the back end, it can blow up your deal and prevent you from getting financing. So you can do it. It's something you should think about so that at least you're aware of the risk. And let's kind of move on here a little bit to the Series Seed. So Series C documents are kind of their middle position between convertible debt or convertible equity and a traditional venture rounds. They're available at seriesseed.com. Basically, it's an old school A rounds, okay? Less terms to negotiate, therefore cheaper to negotiate, a bit less diligence. Actually, before we move into this, there's one other comment that I wanted to make talking about convertible notes and convertible equity. You need to be careful. One of the nice things about them is that usually there are a couple of things. There are very limited reps and warranties in terms of the IP ownership, um, which the rep and warranty is basically a statement of fact, which you're basically guaranteeing that X, Y, or Z is true unless you put it in a schedule of exceptions. Um, you don't necessarily want those in there because you can end up with liability if it's not true. And of course, to verify whether or not it's true, it costs time and money. So usually we try and avoid having those things put in there. There are some reps and warranties usually around whether or not the company is properly organized and authorized to engage in the financing. Um, but there are those sorts of things that are in there. The other things, another pitfall that you got to watch out for, especially if you're dealing with folks who are outside of the Silicon Valley ecosystem, is they may ask for a personal guarantee on the notes. Um, the personal guarantee would mean, not just that the company would need to pay the money back, but that you, as the founder, would need to put your personal savings on the line. You know, for tech companies here in San Francisco or in the Silicon Valley area, that just ain't done. You know, people, the folks who would be investors whom you'd be wanting to solicit, whom you'd want to invest in your company are sophisticated. They know that it's risky. We'll talk a little bit about this in a second, but they should be comfortable with being able to lose all their money. Now, nobody wants them to do that, but the reality of it is that these are very, very risky investments, and the founders, the investors know that, and they're not going to hold the founders personally accountable for it. So, Series C documents, much more limited than an A round. Usually there's a stock purchase agreement. Well, why is that? Because Series A is excuse me, Series Seed is stock. It's preferred stock, in fact. It sits ahead of the common, and it has certain rights. It has a liquidation preference. That basically means that, should the company go under or be sold or there be a change of control, i.e. somebody buys basically a majority stake in the company, the Series Seed folks get their money back, usually 1x, sometimes more than 1x. And I'm about to sneeze, so bear with me a second. I'm going to mute my mic. One more second, sorry. All right, sorry about that. I've been getting over a cold, and of course I didn't sneeze, so it may come back to haunt me. Usually associated with Series C, and you can check this out online. There's going to be a board of directors seat, and some information rights. So basically, those shareholders are going to be able to have somebody on the board, just to take a step back, especially for the newer entrepreneurs. The way that companies are set up, and this is one reason why we use corporations instead of LLCs, is that there's a board of directors. So the owners are the shareholders. They get to vote on who is on the board of directors. The board of directors makes the decisions for the company, and then the executives, who are the officers like the president, the CEO, the vice president, the secretary, the treasurer, they carry out the directions of the board of directors. So, those investors who are putting in $1.5 million, $2.5 million, they want a seat on the board. They want to be able to have some influence on the direction of the company. And you want to be kind of going back and just echoing what I said before. You want folks who are investing in your company who kind of work in the space and understand how it is, and have connections. Now, again, there's some risks, especially as you're approaching people. They may be competitors. You don't want to give away, your trademarks and your valuable IP. But having the right people on the board will open up doors, and they will. One, will open up doors, and two, they'll be able to spot issues and give you perspective that you wouldn't otherwise have. So it's very important to properly structure your board. I guess that's kind of the takeaway from that. There's a lot of things that are negotiated in a venture round, and again, this is just a shameless plug for our January 12 series discussion on Series A rounds. There are investor rights agreements and voting agreements. Those have to do with being able to force people to come along if there's a sale of the company, and all kinds of veto power for certain corporate transactions, whether it's a merger, an acquisition, or a number of other things. And so, I'm sorry, I just lost my train of thought. So those things are not negotiated generally in a Series Seed round. Okay, it costs a lot of time and money to negotiate them, and then to get them documented. I mean, we're talking hundreds of pages of documentation. A lot of diligence. Okay, when I say diligence, that means going through all the corporate books and records, taking a look at what the agreements are in place between all of the founders, all of the other service providers, maybe some sort of patent search, and the Series Seed round is meant to be much slimmer than that, save a lot of money. That being said, in Series Seed rounds, you'll find basically provisions in there that say, look, we know we're not negotiating these things right now. We're going to defer to the next round, and we're going to get the same set of rights as the folks who are investing in the next round, which is, usually a Series A round. Now, great question from Dan. How big would a startup board be? So we get this question all the time, and it depends. Your board is going to evolve over time. Okay, usually, setting them up, we like to see, we always like to see an odd number of people on the board. Okay, the reason is we want to avoid deadlock. If you got two, each of those board members may have a different opinion. You can't get an issue decided. It could sink a company, right? Theoretically, you could go to court and get a court order, and either, if you get some mechanisms in there, you could appoint somebody who's neutral, or the company gets dissolved. So kind of a disaster. We like to see odd numbers. Usually we'd see either just one right at the very outset, or sometimes three. Part of this, and one of the other fun things, is that there's the law, which is very important, and then there are business and personal relationships that are at stake here. And one of the sort of one of the pitfalls potentially of, let's say you got three founders, everyone becomes a board member. Well, when it comes time to do your Series Seed round, or it comes time to do, a Series A round, and they want to put, make it so that the board is composed of, um, one director from the common, basically normally a founder, one director from the preferred, and then an independent director. That means you got to have two people step down. Um, Maybe that's not that big a deal, but normally that doesn't bode well for people's egos. So, we like to sort of see those issues hashed out ahead of time. So, kind of to go back and answer, it depends sort of at what stage. Usually right off the bat, we either see sort of one or three. Kind of at the series seed round, we normally sort of see three. Kind of at the A or B, it might still be three. Maybe it goes up to five. You don't want to hand out board or officer seats willy-nilly, though, because you need those, and they need to go to strategic. They need to be used strategically. In California corporate. So usually we set up startup companies with Delaware corporations, and they only need to have one director. California has a whole set of rules on, um, if you have more than one shareholder, you have to have more than one director. And so, sometimes those things come up and are an issue too that we have to hash out. But again, always an odd number, and use those seats sparingly. Uh, I've got a question from Nasser. Who could be the best consultant regarding the valuation of a startup? Oh, I think he's talking about a valuation of the startup. So the valuation, that's a good question. Um, all of this is just a product of negotiation. So, maybe if you've worked with somebody who's in your industry, um, they may be able to help you do that. Sometimes there are some bankers out there, but it's kind of more art than science. And it's all a huge product of negotiation. What you can work out with your investors, how can you convince them you guys are really worth as much as you think that you are? Because the valuation is it is the it is the big Megillah. It is how much of the company you're going to be giving away on this round. So, I think it's appropriate to work with folks who are maybe in your industry, and find those kinds of advisors, and obviously get the right kind of consultant and advisor agreements in place to work with them as you do your numbers. There are folks who do valuations, right? So, one of the things that we always highly recommend before you do issue stock options is that you go out and you get a valuation. And there are companies that do, they're bankers who do what are called 409A valuations, and there are some accountants that do that as well. So there's a cottage industry of folks who do that. Most of the time at this early stage, it's really just kind of more what you can negotiate, right? So if you can build, a cogent model and reason why, the market is X size, and you expect to get XYZ in terms of penetration, and your profit margin is going to be blah 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 blah, and the typical multiple in that space is X. If you could do that and you can convince somebody, that's how you get to your valuation. I hope that answered your question. Okay, so we got an extensive question. I mentioned that Series Seed is a middle ground between convertible debt and a traditional A round. From the description on the slide, conditions for Series C look quite close to terms for VC. My question is, how is Series C different than a Series A round? Uh, I think you've asked a couple questions now, Philip, and each one of them has preceded a slide that I was just about to get into. So, kudos. And so what's the difference between Series A and Series C? Well, we'll go much more in depth on it on the 12th of January. But, what is not in there? Well, price-based anti-dilution protection. So what does that mean? That means basically what happens if you have a down round. Registration rights. Um, basically if and when there's an IPO and the circumstances surrounding the IPO, what's in there. Right of first refusal and co-sale rights, okay? Those are, hotly negotiated in the and normally in a Series A round versus a Series C. So we're talking about, if someone and who, if they sell their stock, who's got a first right of refusal, how much will it be, the mechanics of getting all of that involved. Co-sale rights, we're talking about basically if one person's going to be able to sell their shares, will somebody else be able to insert themselves in that deal and sell those shares? Voting agreements, also hotly contested. Are they going to be able to, if they want to sell the company, are they going to be able to compel you? Uh, are they going to be able to compel you to come along and do that? So all those types of things are in there and documented, and that takes quite a lot more. And there's also a substantial more, there's a bit more diligence that's associated with a Series A round. I know I say, well, they're vetting the cap table and they're doing this and that, and all that just sounds like it'll just take a couple of hours here or there. No, it takes quite a lot of time and it takes a lot of effort back and forth, especially if folks haven't been keeping, if the startup hasn't been keeping its books and records correctly from the outset. So I got a question in terms of how much equity is typically given up at the Series seed stage. Again, we see it kind of all over the map, but usually, we're not seeing, we're not seeing majority stakes given up. We're seeing sort of 10 to 20% or maybe 30%. One of the things that you have to kind of keep in mind, well, first is again, it's all that you negotiate. Second is that um, the concept of dilution, every time we work with founders, they're super duper concerned about dilution, and they should be, right? Because, what we see is that over time, the founders of the company, they raise capital and they become diluted, okay? Uh, that's just what happens usually in venture-backed companies. Frequently there is a tipping point, especially if they don't do as well as they planned to do, where they may no longer have a majority stake in the company. It just sort of sometimes depends how long that takes and how many rounds it is. That being said, if things are going well, you've got much better market power, and you will not be diluted as much. Or if it appears that you're going to be diluted, you will be able to negotiate basically true ups. So, you'll be getting more stock options so that you won't be getting diluted. Got a question regarding salary as part of your seed funding. Yeah, I mean, the seed funding is about getting that team together. It's about paying for typical corporate expenses. Um, having money to, if you're the CEO and having money to live, yes, that is in there. And so, if it's negotiated, you can negotiate a budget along with that. We're doing one of those right now. And there are, you know, I'm sorry, you can have a budget in there if your investors sign off on that, or that's legit. Now, you couldn't necessarily have an exorbitant budget. You couldn't necessarily be raising $1 million and giving yourself 900,000. But if it's a reasonable corporate expense, we would expect to see folks getting some sort of salary. In terms of the other question we get is, well, if there's a founder and he or she has put in, let's say, $50,000 of their own money, or even $10,000 of their own money, can they get that money back? The answer is yes, but you definitely need to negotiate that ahead of time um, with the investors, okay? Because they're going to be investing in the future of the company, not the past. And they're going to want, usually what you see is that these this round is going to be used to fund expenses to get to the next level, not pay back debt from the last. So again, sometimes we do see, especially in a Series seed round or a Series A round, um, you know, uh, once the company gets some traction, the investors are going to want to see the founder get some liquidity, some cash back, but that needs to get negotiated ahead of time. Otherwise, you run the risk of being you run the risk of being untruthful in your documents and getting sued. In terms of what records should get kept from the start, well, we see that we want to. Okay, I got a couple people unfortunately who have lost audio. I got. Can you hear me, Alan? Uh, so what records should be kept from the start? What we'll usually see is that you want your company set up correctly, right? So typically we see a Delaware C Corp, that means, you got to get your articles of incorporation together, you got to get your bylaws, you want to get founders agreements in place, you want to get proper kinds of consultant agreements in place with the people that you're working with, with IP assignments. You need to keep all of those records because that stuff's important. What investors are interested in is having the value of the company grow. That means, tying on paper that the IP that's getting generated is going to the company and that the money that's getting put in is actually going to the company, and the relationships of the service providers or the technicians, whether they're the guys or gals who code or the sales team, all those people have written relationships with the company so that the investors know what they're investing in. They're not investing in a lawsuit. Um, in line with that, what are some real pitfalls or problems that we see? Well, people who say, well, come work for me, I'll give you 20% of the company. The way that corporations are set up, or the owners are shareholders, they have a certain number of shares. In their articles of incorporation or certificate of incorporation, there's an authorized number of shares. Let's say it's like 10 million, right? If they issue 1 million to each founder and there are 3 founders, then there are 3 million outstanding shares. So each one of those founders has 1 million over 3 million, or a third of the company. If you're just running around saying, well, you have 30% here and 20% here, it's of what and when. So it just becomes a paper chasing nightmare to try and identify exactly who has what and when at the time of financing. So keeping all of those relationships in order is crucial. And that's one of the things that working with counsel can do. I'm kind of running down on the hour here, so I know there are a couple more questions. I'm just going to run through basically 2 slides real quick, and then we'll take all the additional questions. So decisions. Just to kind of recap, convertible securities, they're most common and cheaper and simpler. They're done much earlier on, so you're raising a few $100,000 up to $1 million and $1.5 million. We've seen them done bigger before, but usually once you kind of get to around the $1 million, $1.5 million mark, people are putting in enough money that they want to have more than just the right to invest in a later round. They want to have some control, some say, some board seats, those types of things. One of the downsides, at least for convertible debt, is that it is debt and it may be required to be repaid at some point. And that means actually, because it's debt, if it hasn't converted, there's actually kind of an extra liquidation preference. So, in bankruptcy court, secured creditors get paid first. Secured creditor is basically somebody who has a security interest or like a right in some specific property. Other creditors, debt holders, are paid second, and then equity is paid after that. So, believe it or not, sometimes the convertible debt holders would sit in front of, well, the convertible debt holders would certainly sit in front of the common shareholders, and they may even sit in front of the Series A holders if they didn't convert into it at that point. One of the other pitfalls is not complying with the securities laws, and we're not going to have time to go into all of it, but even though you're just a startup, you're a small company, you need to make sure that you're complying with the securities laws. So these are just some of the things that we kind of take a look at and try and make sure that we're hitting those exemptions. And then that is it. I want to thank everybody for attending. We've reserved some time for folks who are interested in chatting with us on Monday, Tuesday, or Wednesday at 3 o'clock. You can get in touch with me. We could see, if you've got some questions, I'm happy to chat with you. Again, it would be general information. It would not be specific legal advice. It'd be an opportunity to see what your issues are and give you some general information, see if we could work together. We'll make the slides available to you. And that's about it. I'm going to stay on and answer a couple questions that are coming in. But other than that, again, thank you very much for attending, and I hope you got something out of this. All right, so we got a question here from Fred Stein. If there's substantial IP being brought into the startup, is this valued as equity? Is it valued as shares? So normally what happens, okay, um, I imagine what, it's kind of hard to answer this question in a vacuum, but normally what happens, at least with regard to founders, is, they will be assigning the IP and they will be maybe paying some nominal amount of cash for their shares. So there is an exchange that's shares for the IP. Um, and so I think that answers your question, but if not, feel free to ask a follow-up. Oh my gosh, Fred, you got another great question here, which is there a precise definition of founder or co-founder? Um, Again, this isn't necessarily a legal term per se. Um, it's obviously a hot area and subject to a lot of negotiation and also subject to a lot of heartache too. So, from a legal perspective, a founder's not really a title in the sense that they don't have any special duties or obligations like a CEO would have. But certainly when we're talking to people about being brought on board, even if it's kind of after an A round, sometimes, if they're bringing in somebody who's a heavy hitter, he or she will want to be known as a founder. So, the answer concisely is no, there's not a precise definition, but it is certainly one that is hotly, hotly negotiated. Will the session recording be available? Yes, it will be. So I think there was a crowdfunding regulation for seed funding, and if done with, right, Paul, I think, has been doing a lot of reading online. So let me just chat a little bit about crowdfunding. I'll just kind of wax, hopefully, poetic on the subject. Uh, so there are kind of two related things. I mean, there's crowdfunding under the Jobs Act, where there are rules and regulations about being able to get access to basically small investors to put money in, versus now I block it on the name of the platform, but pre-selling goods or services on. Chelsea, do you know what I'm talking about? I'm looking for a word. Hold on one second. I don't know. I'm getting over a cold. Can't think as fast as usual. But basically, obviously, there are some companies out there where you can basically pre-sell your goods or services online. That is taken out. That's different than what we're talking about here. We're talking about people getting securities, whether it's debt or equity securities in exchange for some cash, rather than just basically pre-buying rights um, to product. So at least in the venture-backed company space, we're not seeing a lot of traction for seed funding. There are a few reasons that are associated with that. Under the Jobs Act, the regulations they're still cumbersome. They're not as cheap. To do a round where you're going to raise $1 million, off the top of my head, I think you have to have you know financials that have been audited, I think, by an independent accountant. There are all kinds of information disclosure requirements. There are limits on the amount of money that you can take from investors. So by the time you've done all of that, you could easily be looking at spending 30 or $50,000 between legal and accounting to make that happen. Versus if you were just raising money from a convertible debt round and you had accredited investors, which we highly, 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 highly recommend. You know, yeah, I can't say the exact number because we've seen deals range from anywhere from 5,000 to $25,000 in fees, but it's substantially less. So that's one aspect of it. The other aspect of it is then all of a sudden you've got all these non-accredited investors involved in your startup. They don't know how business is done. If and when it's time for them, you want to sell your company or go public. It again creates like a real legal and accounting nightmare. So we've not seen, at least for venture-backed companies, um, crowdfunding be a real source of funding for them, at least at the seed rounds. But it's certainly asked about all the time. Could you start with a general partnership between founders with fixed percentages and then incorporate later and convert the percentages to shares? Yes, there are a few issues that come up in that sense. I mean, you know, one issue is that there's unlimited liability in a general partnership, so you're on the hook completely for whatever it is that your partner does. The other issue is, one of the reasons why we'd like to get a corporation in place with vesting agreements between the founders is statistically one of those guys or gals is going to leave within a year or two, and you don't want them walking away with a huge chunk of the company. So, it certainly is possible. We patch up partnerships. We make them into the right vehicle moving forward. We patch up LLCs, but it costs more to get that stuff done than if you'd done it right the first time. And Dan, yes, Kickstarter is exactly what I was looking for, so thank you. Yep. Yeah, and so let's just talk about Kickstarter for a second. Again, you're pre-selling goods or services, and it's fantastic. It works really well for consumer goods. So if you've got like the next Yeti um, cooler that's coming out, fantastic. If you've got, and I've seen it also done for theatrical productions. I got a buddy of mine who, was doing a Broadway play, and they actually went out and raised financing, but separately they did a Kickstarter campaign to kind of get interest peaked. So Kickstarter is not, it's kind of called crowdfunding because you're getting funding from crowds, but it's not crowdfunding in the sense of the Job Act, and that you're selling securities. Um, I got I got another question from INT9 Solutions. I have a vast area of IP and I want to assign modifications of our IP to our startup. Can we do this without trading the original IP? That's a good question. I totally cannot answer that just on this. Um, but let me just talk about some of the issues here that come up with founders. I often get the question of, a founder has developed something, some technology, and he or she or they want to license it to the company, um, and rather than and they want to keep it themselves, right? So they want to keep it themselves so that they have this right, and then they want to license it to the company or just give them part of the IP. Well, I can understand the desire to want to do that. What we generally find is, unless you're in that situation where you have just a tremendous amount of bargaining power, right? Like you're the Mark Zuckerberg, um, you know, your investors are going to want to see that you're all in, okay? And they're going to want access over all of that IP. So we don't typically see that being successful in a company that is or will be venture backed. Normally, they're going to want to have all that IP tied up in the company. The other thing too that is in there is that when you are, excuse me, a director or an officer of a company, you have fiduciary duties to the company. So one of the concepts that comes out of that is that uh, you have obligations to be loyal, to give the company all of the opportunities that exist in that line of business. So if you want to do that, you want to pursue a separate line of, a separate but related line of business. Uh, Again, investors generally aren't going to want to see that, but if you are and you want to pull it off, you need to get disclosure, both with regard to the investors, and then that needs to get properly documented in the corporate documents. So, you know, generally approved by, disinterested members of the board. So that's how that sort of shakes out. So with that, um, we will make these slides available. I noticed going through them, there's one or two typos, so my apologies. And if there are no other questions, thank you again for attending. We'll make these slides available to you. We've got some time set aside Monday, Tuesday, and Wednesday at around 1:30 to 3:30 to 3 o'clock p.m. And look forward to working with you, or at least getting to know you a little bit more. Thanks again. Bye-bye.